Yeah, tell him. Tell him. That's right. That's right. I was going to give him a hard time, but I can't. All right, let's get started today. What we're going to do today, we're going to talk about your first test, which is coming up on Tuesday, covering chapters 1 through 4. We're going to review the practice questions that are on Canvas. So we'll work through all of those. Also, a couple of things that I wanted to make you aware of. There was an extra point opportunity that I said for the career fair that's coming up, okay, 5 extra points. There's also going to be a second opportunity coming up for 5 additional points. And that is going to be, we're having a banquet for bankers in the area. Maybe in the director of the Center for Banking. We sponsor this every spring. And so there are going to be a lot of bankers there. There's going to be the presenters from the St. Louis Federal Reserve Bank. And that is going to be on Wednesday, March 1st at 7 p.m. in the small ballroom of the Curris Center. Okay? Wednesday, March 1st, 7 p.m., small ballroom of the Curris Center. It's going to be just kind of a business casual type thing. You know, you don't have to wear a suit. You don't have to wear a tie. If you have to, you can wear. I don't care if you wear jeans and a nice shirt. Okay, it's just the way it works is if you are a senior in finance or economics, then I would buy your dinner. But since most of you don't fall into that category, but if one of you do, let me know. It's just open to all students for the program portion of it, which starts about 7 o'clock. Okay, so there'll be plenty of room. Show up, 5 extra points. Go to the career fair, 5 additional points. That's 10 points that could be added to a test grade. You may not think that's a lot now, but it will mean a lot at the end of the semester for some of you. The career fair is March 14th. Thank you. That's the all major career fair? Okay. Then they've got a STEM career fair, which is the next day, the 15th. And I'll send out an email about the banquet, time, location, all of that. I just want to make you aware of that. Also, one other thing that, and actually I tried to pull up the web page, but maybe they've changed it. I don't know. And you probably don't know this, but on campus here, we've got a group of students and faculty and staff, of which I'm one of them, and we sponsor financial literacy events on campus 2 or 3 times per year. The reason is most students, I've talked with you about this before briefly, most students don't know much about finance, especially if they're a non-business student. I mean, think of your friends who are in the sciences or in the whatever non-business category. You know, we just kind of give you a degree, throw you out into the world and say, okay, figure out how to finance your car, figure out how to open up and keep your bank account going correctly, how to invest for retirement, how to save for your kids' college education, how to buy a house. But we don't teach that. And so the student group, which is called FREE, that stands for Financial Responsibility Empowers Everyone. And they're supposed to have a website, but I couldn't get it to come up earlier. I mean, we do have an active website. Also, we have Facebook, Twitter, and something else, some other kind of account. But if you want to take a look at basically what is happening in terms of what students know about finance, there's a short video here, and it's pretty entertaining. in terms of what students do know versus what students don't know. They know a lot about pop culture, okay? They don't know much about finance. So you can watch this. These are Murray State students that we went out and interviewed. The reason I'm mentioning this is anyone who is interested in serving on, we've got an advisory board, which just kind of helps us come up with, what programs would students be interested in, helping us market these in terms of putting up flyers, talking to your fraternity brothers, sorority sisters, residential college people. If you're interested in serving on this, plus it looks pretty good on a resume, we have our meetings normally on Tuesdays at 3 o'clock, I think, or 3:15. That could be changed around some. So if you're interested in helping out, come see me, contact me. I'll put you in touch with our graduate assistant who kind of heads this up. And really, there's not a lot to this. I mean, it's a pretty easy thing to have on your resume. Really, our big thing this spring is going to be during, what's the official name of it is Financial Education Week or something like that. It's going to be in early April. We're going to have 4 days worth of programs starting at 4 o'clock each day. That's basically it for this spring. But we need ideas in terms of what would help you, what would help your friends. Because there's no need for us to get speakers and give away a lot of door prizes and all of that if it's not going to benefit you. So again, anybody who's interested, let me know. You can send me an email. I'll pass it on to the person in charge. They'll put you on the email list. And if you can show up at some of the meetings, that will be fantastic. All right. Because this is supposed to actually be a student-led organization. All right. Any other banquet, financial literacy? I think that's it. Any other questions or anything before we actually jump into talking about the test itself? All right. Let's talk about the test for just a second. Your first test is going to be on Tuesday. You will have 90 minutes to take the test. If you need it. You shouldn't need that. Okay? This is the first test you've had with me. For most of you, this is your first finance test. I understand that can be a little unnerving. What I would suggest is, as I mentioned already, start studying as early as possible. Read the chapters. Take a look through the slides that are presented. You can always go back and listen to watch the integrity recordings. And if you put enough time in, it's going to take some time to do this, okay? I mean, this is not one of those tests for most people where you sit down an hour before the test and thumb through your notes and make an A on the test. I mean, I'm just being honest with you. It's not. I don't make it hard. I don't make it easy. I try to make every test that I give fair. So if you walk out of here on Tuesday and you're saying, "Oh my gosh, that was a terrible test," but if you say that was a fair representation of what we covered in class, I've done all I can do. Or if you walk out of here on Tuesday and saying, "That was so easy. I studied way too much for that test," that's fine, as long as you think it's fair. Now, I will tell you, most students on the first test, and I've given this, have given a lot of first tests in this class, if they don't do as well as they'd like, their simple reaction is, I should have started studying earlier, and I should have studied more. Most people don't walk out of here saying, I studied way too much for that test. Now, again, I'm not trying to scare anybody. I'm just being straight with you that you need to prepare. I want to see you all do well. There's no rule against everybody making an A on a test, okay? So I want to see you all do really well. There's also a study guide, which is, now again, there's some practice questions here at the very beginning. Okay, this is in the back of the chapters, 1, 2, 3, and 4. If we jump down to test material, which is down here, testing items, then you're going to see this is a practice question regarding financial statements from chapter 3. So it's just kind of an all-inclusive type question, or problem, which might be pretty good. These are the practice questions that we're going to talk about today. This is a solution to this problem. These are going to be the answers to the practice questions, although I don't think they're worked out. We're going to work them out today in class. This is your study guide. Let me just go ahead and pull this up really quickly so we can take a look at this. And again, it's kind of basic, you know. For example, for chapter 1, you know, we had a definition. What is finance? Why is it important to study finance? We talked about the basic forms of business organizations. Sole proprietorships, partnerships, corporations, and the strengths and weaknesses. So you need to know those. Also, how is finance related to economics? We said finance and economics make decisions based on the margin. Okay, so we gave an example of if the marginal cost of a project is greater than the marginal return or the marginal benefit, we're not going to invest in that project. I mean, it's pretty simple. We also talked about finance and how it's different from accounting. Talked about two different things. One was accounting versus finance. Finance uses the cash method when it comes to keeping up with sales and expenses. Accounting uses the accrual method. The second was that finance stereotypically is a decision-making function. Accounting stereotypically is an information-gathering function. Okay, so those are the two differences. What roles do cash flows play? I mean, this is basically just saying that cash flows are extremely, extremely important in the world of finance. That's what we look at. We want to know how much cash is coming in or flowing out. The key activities of the financial manager, you can take a look at that in your book. We kind of skip past that. The goal of the financial manager and the goal of a firm overall. This is going to be a question. And the answer is maximize shareholder wealth. Okay, it's not to maximize profit. Maximize shareholder wealth. Another way of saying that is maximize stock price. You're going to see that question. I mean, I can promise you that. The goals of a financial manager, we'll see, what's the next one? What is wrong with profit maximization? We talked about three things that ignores. For example, the timing of the cash flows, risk, etc. So that's in your slides. The agency problem, I don't know if there's very much about this in your book, but you need to know that. It's in the slides, okay? So we said the agency relationship is when managers want the best for themselves, stockholders want the best for themselves, and there's a problem there, okay? And so we went through things like agency costs, how do we minimize that, who pays for agency costs, that kind of thing. Also, there's a small part in your book on ethics, so take a look at that, and also the risk-return trade-off. This is found on the last page of your syllabus. It's one of those terms that we mentioned during the first day of class. And basically, that's simply saying that when you're investing, you can't have a low-risk, high-return investment. There's a trade-off. If you want a higher return or a higher expected return, then you're going to have to take more risk. If you want a lower return, then you can take less risk. But there's a trade-off there, so that's what that's referring to. Chapter 2, this was the chapter that I posted the integrity videos for. I think I posted 2 of those, and also the next day when I came back from when I had the flu, we reviewed quickly part of chapter 2. But we talked about a financial in the video. What is a financial institution? What's the definition? What are examples? What's a financial market and examples of financial markets? Also, corporate income taxes and how to calculate them using a tax table, which will be given to you. So I'll give you the exact tax table that you see in your book. Ordinary income, that's simply income from the sale of businesses, goods and services. Capital gains, that's when an asset is sold for more than its book value. Average and marginal tax rates, what are those? Also, how to treat interest and dividend income. There's a tax benefit to dividend income for corporations. Okay, this is not for individuals, but for corporations, and it discusses that in the video. And also, what is a tax loss carry back and carry forward? And that's discussed in the video also. But that means if a company has an operating loss, they can take that loss back up to 3 years and forward up to 20 years to help offset any future tax liability. And then an S corporation, we talked about that maybe back in chapter 1 actually, but we said an S corporation is simply a corporation who passes its income through to the shareholders and then they claim it as personal income. So it's not like a C corporation whose income is taxed twice. Chapter 3, pretty simple. Types of ratio comparisons, the cautions for ratio analysis, also know how to calculate the various ratios and what they mean. Okay, just pretty important. We went through and talked about all of that, worked through it. Know what a balance sheet, income statement, statement of retained earnings, and statement of cash flows, know in general what they look like. You may have to put together a simple income statement or balance sheet, and I'll give you an example of something like that today on the practice question so you can see kind of what I'm talking about. And that's what this is referring to, the very last item here. Chapter 4, depreciation. What is depreciation? How do you calculate it if you're given the depreciation schedule, which I will give you that. Also, we talked about cash flow earlier, but also we talked in Chapter 4 about the accounting definition and the finance definition of cash flow. So it's pretty straightforward, pretty simple. There won't be anything complicated about this at all. And that goes into the next one also. And then the last three here, these are the three items that I said are related to financial planning. I said in Chapter 4, financial planning, I don't think that's a good place for it, and you need to know three things about financial planning. This is on the Chapter 4 slides, okay, towards the very end. It is, what's the primary purpose for preparing a cash budget? What is the primary purpose for preparing pro forma financial statements? And short-run versus long-run financial plans. Basically, I'm asking here, which one do you develop first? Do you develop your short-run plans and then develop your long-run financial plan, or do you do the opposite? And that's basically it in terms of your study guide. Are there any questions about the study guide before we start working through some of your practice questions and problems? The format is going to be 50 multiple choice questions. I don't know what else. Yeah, that's basically it. 50 multiple choice questions. You've got 90 minutes to take the test. It will be similar to those types of questions, okay, and some of the ones that we look at today in class. Actually, some of the ones we look at today in class might be a little more difficult than what you might actually see on the test, but I'd rather you over-prepare for the test than under-prepare. It may give you some nice little softball questions, and then you get through the test and then just slam you with some, really hard questions. I know some professors, that's kind of how they like to do. I'd rather you over-prepare than under-prepare. All right, so study guide. Now, let's take a look at, and if you're listening from in the online class, which this review will be good for you also, then I sent you out a separate email regarding your test, when the test starts, and all of that good stuff. All right, now let's see if we can fit all of this. Okay, there are 20 questions given to you. And again, some of these are going to be a little more difficult than what you might see on the test. For example, number 1. But these questions really help you in terms of preparing, in terms of studying. All right. So number 1 says, which of the following statements is incorrect? So take a look at that. Let's kind of work together on this. The multiple choice, we'll just kind of discuss these. The problems, I'll actually work through those for you, okay? And some of these come from reading the chapters. So as I mentioned earlier, yes, I would read the chapters. So in looking at this, which one would you say is correct? Okay. I'm sorry, incorrect. Yeah, incorrect. The answer is going to be A. Large European firms generally have more individual owners than large U.S. firms. Okay, that is incorrect. And that just goes to show you, you need to read the questions really carefully on the test. Okay, and again, I'll remind you of that on Tuesday. But every test, I tell students, read the questions carefully. You've got plenty of time. Also, if you skip a question, remember to come back to it and answer it. Even if you have to guess, it's multiple choice, okay? So you can't hurt yourself. Every single test, I have at least one student who leaves a question blank. Simply because they got in a hurry. I mean, it may not sound like much, 2 points. One time I had a student leave 5 questions blank. That's 10 points that they lost, and they could have guessed. If they're at 4 answers, you've got a 25% chance of getting it right. So you would have gotten, statistically, at least one of those correct. But, so again, I will remind you of that on Tuesday. All right, number 2, which of the following statements is correct? This has to do with the different business organizations. Well, this has to do with a lot, actually, from Chapter 1, agency problems, maximizing income. And it doesn't necessarily say it like I did in as simple a manner. Okay, so that's basically saying that maximizing profit or net income might not be the best goal, and because it could basically ignore maximizing stock price. Okay, so E is the correct answer for number 2. All right, here's a problem that we can work through. So take a look at this for just a minute. Company currently sells on the open market for $30 per share. That's its stock price. It has $100,000 in debt. Operating profits are $54,000. In addition, it has stockholder equity of $200,000 and 10,000 shares of common stock outstanding. What is the company's market to book ratio? So market to book ratio, the formula for that is simply the market value of the stock divided by the book value of the stock. Okay? And again, you will be given that formula on the test. So if we want to calculate this, and I'll give you just a second to work through it if you want to, and I'm going to work through it also. All right, so let's work through this. Now, I will tell you, right before class this morning, I jotted down some of these really fast. I'm really hoping I got them correct, because it's kind of embarrassing if your instructor gets the problem wrong, but we'll see, I guess, okay? All right, so in this example, the first thing we need, because we're not given this, is we need to know the book value. And it tells us that this company has $200,000 in stockholders' equity, and it has 10,000 shares of common stock outstanding. So the value of this stock in terms of its balance sheet is $20 per share. So that's what the book value means. On the books, on the balance sheet, this stock is worth $20 per share. But what we need to know is the market to book ratio. And so the market to book ratio is going to be the market price per share divided by the book value per share. And it gives us the market value. It has to give you this, okay? So that's $30 divided by, we just calculated the book value, which is $20. And so this is going to be 1.50 times. So this stock in the stock market is selling for 1.5 times its book value. Now again, it doesn't really tell us much about is that good or bad, but that at least answers the question. And so that should match up with answer A. Now, if we go through here and you're not sure where some of these numbers come from, okay, stop me, let me know, and we'll take a look at it closer. Because I want to make sure everybody's comfortable with this. Also, I forgot to tell you, look at these practice questions because you may actually see some of these practice questions again. Let me say that one more time. You may actually see some of these practice questions again. That's all I can do for you, okay? If you don't understand what I'm saying, I can't help you, okay? All right. I'm not saying all of them. I'm just saying some of them. Okay, so all right, number 4, another problem. A firm has interest expense of $2,600, total assets of $180,000. In addition, operating profits are $10,000, gross profit is $28,000. What is this firm's times interest earned ratio? All right, hopefully I worked this one out too this morning. I think I did. All right, I did. Okay, so this one you're given a lot of numbers. You actually don't need many of them. You need 2. Because the times interest earned ratio, what is the formula for that? Okay, so operating profit or EBIT divided by interest expense. So the times interest earned ratio would be the operating profit, which it says is $10,000 divided by interest expense. We said the interest expense, that is a mandatory payment, okay? A company doesn't have the option of not making their interest payments. They have to pay that. And so what this tells us is this ratio of 3.85 times, this gives us a measure of how much cushion do we have when it comes to making these mandatory interest payments. And so for this particular company, they make 3.85 times as much in operating profit. So they've got a little bit of a cushion there. If something goes wrong financially, if they have a financial emergency, they can still make those mandatory interest payments and stay away from bankruptcy. All right, so everybody good to go on this? And this matches answer D for number 4. All right, number 5. All of the following are examples of current liabilities except what? Okay, so all are examples of current liabilities except A, accounts receivable. Accounts receivable is what? A current asset. Okay, that's exactly right. All right, number 6. Number 6 is a good example. When I told you earlier to know in general how to put together an income statement, this is a really good example of this, okay? It's not really technical, but it has some line items. And if you've looked at an income statement enough, which by the time you get through studying you probably will have, then you should be able to take the information from here and come up with net profit after taxes for this particular company. All right, so we've got a firm, we've got a lot of stuff given to us. Sales revenue, accounts receivable, interest expense, operating expenses, accounts payable, cost of goods sold, preferred stock dividends, tax rates, number of shares outstanding. Some of this we need, some of this we don't need to come up with net income. I mean, you can do it a couple of different ways. You could go through and say, what do I not need? Well, you don't need anything on the balance sheet. So, for example, accounts receivable, you don't need that for this question. Accounts payable, you don't need that for this question. So, in putting this together and calculating this, I'll actually go to this one, so I've got some lines to write on here. What I'm going to do is I'm going to take the first line of the income statement, which is either going to be called sales, total sales, or sometimes it's called total revenue. But in this case, it's $3,060. We're going to subtract from that the cost of goods sold, which is 1,800. And that leaves us with 1,260, which we called operating profit, or EBIT, which stands for earnings before interest and taxes. I'm sorry, this is gross. Never mind. Take that away. Gross profit. I'm getting ahead of myself. Okay, so this is gross profit. Then we're going to subtract from this, and you'll notice they just kind of lump all of this in one category of operating expenses. I think that's what they call them. Yeah, total operating expenses of 600. And so this leaves us with 660. This is operating profit, or EBIT, earnings before interest and taxes. Now, at this point, I mean, we're doing pretty well because we're down to earnings before interest and taxes. The only thing we have left is interest expense and income tax. So, if we have an interest expense, do we have that? Yeah, we do. Okay, so 126 is interest, so we would subtract that. And that's going to leave us with 534. This is earnings before taxes. And it tells us taxes are, it just simplifies it. It says the tax rate's 40%. Okay, so I'm going to put this over here somewhere, okay? So the tax rate is 40%. So basically what we need to do is multiply our earnings before taxes of 534 times 40% to come up with the amount of tax. So we can do this a couple of different ways. We can just do it the simple way, times 0.4, that's supposed to be 0.40, and that's going to equal 214 in taxes. Or if we multiplied, and again, you can do this if you want to, if we took 534 multiplied by 1 minus the tax rate, which is 0.40, you're going to come up with the same bottom line. It's just up to you, however you want to do it. Okay? And so the 214, if we subtract this, let me find where I'm writing here. Go right here. 214. That leaves us with 320, which is our net income. So first of all, let me ask you, does everybody see where all of these numbers are coming from? So if you saw something like this with similar numbers, you could put it together, realize what you need, realize what you don't need. The tax percentage will be given to you. Yeah, so it would be, 30%, 40%, whatever. Okay, so I'm going to add another question to this, okay? It's not on your sheet, but I'm going to add another part of this because we do have the information that we need. If instead of asking for net income, this problem asks for earnings available to common stockholders, then how much would that be? And let me jump back over to the problem, then I'll come back to this. But based on this information, if I ask for what are earnings available to common stockholders, what one change will we need to make based on what we've already done? Because this company has common stock and it has preferred stock. Not multiply. we need to subtract out the preferred stock dividends to come up with earnings available to common stockholders. Remember, we talked about that back in chapter 3, and we said that if a corporation has common stock and preferred stock, then you subtract out the preferred stock dividends to get earnings available for common stockholders. If this company did not have preferred stock dividends of 18, then net income would be the same as earnings available to common stockholders because they don't have to worry about paying preferred stockholders. But in this case, they do. So for this, notice we've got preferred stock dividends here of 18. So to calculate earnings available to common stockholders, we would just subtract from this our 18, and that would give us 302, which are earnings available to common stockholders. Let's see, wasn't that easy? All right. So everybody's good with this. Okay, number 7, which of the following mechanisms is not used by shareholders to get managers to act in the shareholders' best interest? Okay, the answer to this is going to be C, a golden parachute. A golden parachute simply pays managers to leave a company. And that was kind of a popular thing back in the 80s and 90s, early 2000s. You're not seeing as much of those anymore. But it simply says that if we want you to leave, if we fire you, we have to give you some humongous amount of money. You know, we've got to pay you $50 million, $100 million, whatever. Okay? So if you're a manager, you would really like to negotiate a nice golden parachute clause into your contract because they're going to pay you to leave. But stockholders kind of got wise to that, and they said, look, why are we paying somebody to leave if they have to leave? Apparently they're doing a poor job, so why are we going to give them a bonus for doing a bad job? So you don't see nearly as many of those. All right, number 8. Which of the following statements is correct? All right, so in looking through this, reading through a lot of this, answer C would be correct. It says shareholder agency costs include the opportunity costs associated with constraining managerial freedom, but do not include managerial salary. We talked about this a little bit, and we said, I gave the example of if you have a mid-level manager who finds a fantastic investment opportunity, but it's going to take several $1 million of the company's money, oftentimes they don't have the authority to spend that kind of money. So they've got to send their request up the line, maybe to top management, and then that's going to take a while. But stockholders know this. They know that they're going to miss out on some really good investment opportunities for their corporation, but they'd rather miss out on those opportunities by, as it mentions here, constraining managerial freedom, as opposed to having some mid or low level manager who doesn't have a lot of experience spending millions of dollars of their money, possibly on a bad investment. So that's one of the agency costs that they're willing to take. All right, number 9, which of the following statements about the corporate form of business organization is incorrect? This one's should be pretty straightforward. Okay, yes, A. Because one of the drawbacks to a corporation is it's typically a little more difficult to establish as compared to a sole proprietorship or a partnership. And so A is incorrect. All right, number 10. The annual report contains all of the following financial statements except which one? Okay, yeah, that's pretty straightforward too. It's B. The annual report contains the income statement, statement of cash flows, balance sheet, and a statement of retained earnings. Number 11, which of the following statements shows the portion of the firm's earnings that has been saved rather than paid out as dividends? We talked about this in class. We said when a company makes a profit, they can only do two things with that profit. They can either pay it in dividends to shareholders, or they can put it in their retained earnings account, because the retained earnings account is just like their savings account. They're simply putting the money back to use at a later time. So in this case, if they don't pay it out to stockholders and they save it, they're going to put it in the statement of retained earnings. That's where it's going to show up. So the answer would be C. Number 12, which of the following ratios measures how effectively a firm is managing its assets? Okay, it's going to be D, the inventory turnover ratio. And that's going to be found when you go back and take a look at the slides from chapter 3. You'll see that in there, also in the reading in chapter 3. Okay, this one also is related to number 12. So if you got it right, you can probably get number 13 right. If your goal is to determine how effectively a firm is managing its assets, with the following sets of ratios would you examine? And it would be C, inventory turnover, days sales outstanding, and the fixed asset turnover ratio. And this is where actually I gave an example of if a corporation buys something, for example, like a company jet or a condominium in Hawaii. They spend company money, they spend stockholder money, but they don't use that asset to generate sales, then that's the agency problem that we talked about. This is one of the things where you can look for the agency problem, because there's nothing wrong with buying a condo in Hawaii if you send your customers there so that in the long run it generates sales. Or if you buy a company jet that you use to jump around the country or jump around the world to generate sales, that's fine. But if you only use a company jet for the CEO to fly their family around once a month, that's not the purpose of spending stockholder money on these assets, okay? So those assets aren't generating sales. Number 14, which of the following statements is correct? Okay, so if you look through all of that, what you're going to find is you're going to find a slight problem with each of these statements. May not be a large inconsistency, but something is going to be wrong with each of these statements. So the correct answer is going to be E. All of the statements are false. All right, number 15. Firm has a net profit margin of 15% on sales of $20 million. If the firm has debt of $7.5 million, total assets of $22.5 million, and an after-tax interest cost on total debt of 5%, what is the firm's return on assets, ROA? So ROA is equal to what? earnings available to common stockholders, or if they don't have common stock, it's just net income divided by what? Total assets. So in this case, we need to first find what is net profit. Okay, we know the net profit margin, so we can calculate it. Net profit margin is equal to sales times net profit margin. So in this case, we would take sales of 20 million multiply that times the net profit margin of 15%. There's supposed to be one decimal place there. And so 20 million times 15% is going to equal $3 million in net profit. The next part of it, ROA, is net profit divided by total assets. So if we take our 3 million divided by total assets of 22.5 million, that should equal 0.1333 or 13.33%. Don't these seem easy as we're working through them? I think you're halfway there. I mean, you're almost ready for this test. Another several hours of studying, you'll be good to go. Okay? All right, number 16. Number 16 says, if a corporation that has been in business for many years wants to raise funds by issuing new common stock, its stock will be sold in the blank market. Okay, so I heard one primary. Anybody else? One secondary. And we can also have, I guess, a debt, a money, and more than one of the above markets. Okay, the right answer is A, primary market. The primary market is where new shares of stock are sold. They've never been owned by anybody. So think of it as a new car lot where brand new cars are being sold. The secondary market is once a stock has been sold, then it's in the secondary market. It's a used share of stock. Think of it just like a used car. And whenever, for example, if I buy or sell stock in the stock market, if I log onto my Scottrade account today and buy 50 shares of Walmart stock, I'm buying that used stock. That is a secondary market transaction. But a primary market transaction is where brand new shares of stock are sold. Number 17. This is from chapter 2, which the following factors distinguish the banking system in the United States from banking structures in other countries. Okay, that's going to be, and this one's actually a pretty difficult question. But financial institutions in the U.S. or banks in the U.S. have greater limitations with regard to non-banking business relationships than their foreign counterparts. What that simply means is that banks in the United States, one, they're really heavily regulated, and two, they're pretty limited as to the types of businesses that they can operate. For example, a bank or a bank holding company, they can own, for example, an insurance company, or they can own a mortgage company. But a bank holding company cannot own a television station. It cannot own a some type of internet company other than financially related internet companies. All right, number 18. Which of the following is not an advantage of going public? So that is if a company was privately held and it wants to sell stock to the public. heard somebody whisper, "It's E, it's E." Okay, that's right, it is E. Okay. So all of it are advantages of going public. It allows a firm's founders to diversify their holdings. One thing about privately held companies, a lot of times you think, well, you know, these people are wealthy. Well, they may have a lot of wealth that's built into what they own, but until they actually go public and sell their shares, they have a lot of net worth on paper, but they don't actually have a lot of cash. But then once they go public, that frees up that cash. It increases the liquidity of the stock. It establishes a value for the firm, and it makes it easier to raise new equity capital in the future. All right, number 19, large one-owned public companies can reduce the time required to register and issue securities by using a shelf registration. What this means is they simply go through, they fill out all the paperwork, which takes a lot of time. They get everything ready, and they essentially just place the securities on a shelf ready to issue. So if they are trying to, for example, if the market is really taking off and they think they can sell their shares of stock or their bonds for a really good price, then they can quickly do that with a shelf registration. If not, they'd have to go through the timely process of selling the stock. And number 20, a corporation purchases an asset for $50,000, installation and delivery are an extra $10,000. If the asset has a depreciable life of 5 years, what amount of depreciation can the corporation claim on this asset during the 4th year using the depreciation schedule given to you in the PowerPoint slides? Okay, so you probably don't have that handy, but we've got a total depreciable value of $50,000 plus 10, which is $60,000 for this asset. And if you take a look at the 5-year schedule and take a look at year 4, the 4th year here, you will find that the percentage that we use for that year is 12%, 0.12. So to calculate this, we would simply take the depreciable value of the asset, which is $60,000. We would multiply it by 12%, and that would give us depreciation expense in the 4th year of $7,200. And I think that was question 20, I believe. I think that's the last one. All right, so are there, yes, last one. All right, so are there questions? So that was here. Are there any questions about the test preparation, anything else? Next week, I will tell you, I will be around Monday. I will also be around Tuesday morning before class. So if you have questions, if you're going to make a special trip to campus, you might want to go ahead and make an appointment with me to come by. But feel free to stop by, ask questions. We can go over whatever you need to talk about if you're having problems with something. Otherwise, study hard. Have a good weekend. I will see you back here on Tuesday. Also, think about volunteering for the Financial Literacy Student Organization and be looking for my email regarding the banquet.